How do you raise capital from one of Australia's big four banks? That's a question I'll get answered by today's guest, Justin Greenstein, the Managing Director of 1835i. Welcome to Fintech Chatter, the podcast where I chat with fintech leaders about their secrets to success. I'm Dexter Cousins, your host and the founder of Tier 1 People, the executive search firm that works with high-growth fintech ventures, connecting them to exceptional fintech leaders. In today's show, I'm talking about raising capital from the venture capital arms of Australia's big four banks. You might recall recently we had Graham Strain from Ceto Plus on the show, and in this episode, we go on the other side of the fence to speak with the corporate venture arm that's invested in Ceto Plus. Before we chat to Justin, if you're new to the show, make sure you follow us on your podcast player of choice, or if you're watching on YouTube, hit subscribe. And if you're in the mood, please leave us a comment and give us a like. It really helps us get great guests like Justin onto the show. Justin, welcome to the show.
Thank you, Dexter. Great to be here.
Great.
I'm glad we finally got this into the calendars.
Yes, it's like all of our guests. I think it's polite persistence on my part to get everybody on the show because we're all super busy. But thanks for joining me. Thanks for inviting me along as well to ANZ's HQ in Sydney. Wanted to have a chat with you today about quite a number of different things. First being, I guess, 1835i and the structure that you have here, and then talk a little bit more broadly about the Australian kind of, I guess, venture capital space and some tips that you might have for founders out there who are thinking about working with a corporate venture capital fund. But first up, maybe as if you could tell us a little bit about yourself.
Yeah, sure. So I'm Justin Greenstein. I head up 1835i, and I'll talk a little bit about the history of 1835i and where we've come from. In terms of myself, I've been in the business almost since its inception, so just over 6 years now. And prior to that, I did a number of roles in finance, both at ANZ and also outside of ANZ. And interestingly enough, the last investment type of role I did was in infrastructure. So very, very significant move from, sort of big real infrastructure assets like toll roads and schools and prisons to early stage and emerging technology companies. So it's been a great journey from that perspective. In terms of 1835i, we began as a unit inside ANZ Bank in early 2018. So for those of you on the call and who know a little bit about ANZ and its history, and specifically its most recent history since Shane Elliott took over as CEO, Marley Carnegie joined the bank in 2016 to really start building a digital muscle. She founded a digital division, and part of the capability Marley and Shane wanted to have in the bank was this ability to partner with fintechs, with tech companies that had global aspirations to do awesome things, but most importantly, companies with founders who had a vision and brought a very, very different culture to the bank. So with that vision in mind, we started a business unit called ANZI, really a business unit in the bank, and ANZI was there to do three things. First of all, it was there to source fintech companies that we thought would be good partners and who needed growth capital. So we said, hey, as ANZ Bank, if we can provide some growth capital to these amazing founders, we think that we can get some really great symbiotic benefits going. We can bring a great distribution network of customers to these startups. We can bring, a lot of bank knowledge, really good bank and finance knowledge. And then working with the founders, they bring an amazing culture and brilliant tech minds. And together, if we work with them, we can bring new capabilities into the bank, and we can win, and we can give them access to a great distribution channel and capabilities, and they can win. So that was sort of vertical one. The second vertical we looked at was just partnerships. So we said, hey, sometimes we're going to be working with these companies and actually they don't need capital. So if they don't need capital, we don't have to invest, but let's use this capability that we're building within ANZI to work with them, because working with founders and startups, and we'll get into this, actually requires a very different mindset around how the bank engages and partners with these sorts of companies. And then the third vertical that we put into place was a lab, which is fundamentally an incubator. And what we said is, there are lots of problems that we see as a bank every day, and we believe that some of these problems can actually be solved by new businesses, but new businesses that no longer don't yet exist. So let us try and source founders. Let's build a bit of a talent factory and build some of these startups ourselves, and treat them like a startup. So, help incubate them within the boundaries of the bank, and then spin them out and put capital into these independent companies with founders. What happened over the first 3 years of ANZI is we learned a number of things. And the most important thing we learned was how difficult that cultural intersection is between banks and founders. And that was really more so from that lab perspective. So if we go back to the investing perspective, I'd say what we were really, really, really good at was putting capital into the companies, putting people onto boards, so our board representatives who really understood startups, how to work with startups, and really had that fiduciary understanding of, helping the company build and grow in the best interest of all shareholders. And we had a job to do in terms of working with the business units in the bank to bring the two together and forge the marriage. So that part was, broadly okay. But on the lab front, what happened was when we were incubating these ideas, we would reach out to people who had founded businesses before, who had a track record. And when we said, hey, come and build these with us in the bank, the first thing they said is bureaucracy. How are we going to build a business within a banking environment where there are bank grade policies and bank grade procedures, etc. Because in order to be successful, we need speed, and we need we need the ability to build within really, really, really open guardrails. So guardrails where we're not going to do anything wrong, but we're not necessarily going to be able to tick 150 boxes before we launch business. So that led the CEO at the time of ANZI, Ron Spector, to come up with this idea of spinning ANZI out of the bank into a separate unit where we could remove ourselves from, the perception of all the bureaucracy and banking guardrails that we had in the bank. So in 2021, Ron and myself and a few other people who were in the team spun ANZI out of the bank and formed 1835I. So 1835 represents ANZ because 1835 was the year that we thought ANZ was founded. It actually, going into history books, Shan reminded us afterwards that it was actually 1827, but we decided we don't want to rebrand. Okay. And we essentially formed an external company that is contracted with ANZ to invest in startups, find startups to partner with, and build new companies. So we still do the same three things, but we operate in a separate company outside of ANZ, which gives us much, much more ability to attract talent into as a result of our policies and procedures, which are akin to those of the bank, but not in the bank. So we can just do things a whole lot faster. Having said that, we remain independent from the bank, but our investment committee, so the people who ultimately approve any deployment of capital, still remain the most senior people in the bank. So we still have Shane Elliott, Farhan Faruqi, Anne Strong, Marley Carnegie, Mark Whelan, and Claire Morgan on that committee, which ensures that we remain honest and we continue to source companies and partners that are strategically important to the bank and that we believe we can work with.
Got you. So how would a CVC or a model like 1835I differ to, say, a venture capital fund here in Australia?
So in terms of the legal structure that we've got, essentially it's the same. So 1835I is a separate management company. We deploy capital, but we have one LP, and our LP is ANZ. So the difference between us and a traditional venture capital firm is we've got one LP. Traditional VC funds will have a number of LPs. And the reason that we've got one is that every investment that we make, whether it's an investment in a startup or whether it's an investment in a company that we're incubating in our lab, is there has to be good strategic alignment to ANZ's overarching strategy. Now, what that means is we don't necessarily go and invest in loan companies. What we actually do is we invest in companies that we think provide good adjacent products and services to the bank. So we always ask ourselves, if we invest in a company and we partner with them, can we help ANZ attract new customers? Can we drive loyalty within the bank? And can we drive new capabilities within the bank that we think is going to make a remarkable difference to our customers and our bankers? And what that then means is, we're not just constrained to what I'd call Horizon 1 investments, which is, hey, there's a cool tech company that can solve a problem today. We're actually looking at Horizon 2 and Horizon 3 as well. But when we think of Horizon 2 and Horizon 3, we always ask ourselves, will it be strategically relevant to the bank, even if it's in a world where banking might look a little bit different?
Got you. We're obviously kind of, it feels like Horizon 3's right, almost upon us in terms of how fast technology seems to be evolving. What are some of could you be a little bit more kind of descriptive about some of the kind of technologies and types of startups that you might see as being a Horizon 2 and a Horizon 3 type business?
Yep. So a Horizon 2 type of business is a business that we would say is more of an adjacency to ANZ. So what we mean by that is the service offering may not be groundbreaking in and of itself, but what it does to ANZ is actually quite groundbreaking and quite different. So if we dig into an example on what that could look like, perhaps is we talk a lot about homeowners and home ecosystems. And what we mean when we talk about homeowners and home ecosystems is a mortgage business in ANZ fundamentally. But we also talk about things like gradults, right? So how do we take a gradult who is, in simple English, a person who's probably graduating from their education or, ready to enter the workforce, given, whether it's education decision or other, and about to start saving money towards owning a home. So if we think about a gradult, think about what are they likely to do in terms of their living? Well, maybe they'll rent a place before they can go and buy a home and get a mortgage. So then we start thinking about innovation in the rental space. And some of the interesting businesses that we've started to see in that space is building loyalty with renters. So we've seen a couple of really interesting propositions, more overseas than here, where startups are partnering with banks to help generate loyalty with that whole renter population. So what that means, for example, is we have a loyalty credit card that you can now pay your rent on. So you'll know if you live here, it's unlikely that you're going to go and be able to pay your monthly rentals on a credit card. So if you give some form of card that you can make your rental payments on and getting data around those people, you can then start building connected commerce around them. So now we go out and we say, well, we know where you live. We kind of know your preferences. We've got a whole lot of people in their data. So now we go within the area in which you live and we start connecting with merchants there. So we know that, give or take, people spend roughly 80% of their disposable income after essentials, so after rent, after medical, after education, all those things, within 5 kilometers of where they live. So you can now start building connected commerce around where people live and they rent. So if you live near, let's say, a Thai restaurant on a Tuesday evening, the Thai restaurant will start offering you discounts because they've got low patronage. So you start eating at the Thai restaurant, and then you start learning, well, Justin's probably got 2 children, Justin's probably married, and they can get all of that because they can see that I'm ordering 4 meals. So what's happening now is through this, ecosystem that's getting built, you're getting really, really, really rich data. And what we're now starting to see is these companies are taking a really, really personalized approach to offering the renters properties that they think they can afford. They've got so much data, and they know where you live, and they know what your preferences are, and they maybe know, which school your kids go to or how old your kids are, that they're saying, hey, here are 4 properties within a similar area to which you live and an area which we think is desirable for you. And these are ones that we think are affordable for you based on all the things we know about you. So that's adjacent. That's, nothing brand new there, but the way these startups are building up data repositories and driving personalization and learning about people's financial position and affordability without having pay slips and all those additional things are really, really interesting. So that's what I'd call a Horizon 2 adjacency. Horizon 3, I think we start stepping into the realm of AI, agentic AI, and probably agentic AI crossing over with crypto to some extent.
Yeah.
So what we've seen over the past 12 months is a world where agents are becoming, kind of the norm. I think, most people will know about agentic AI and what agents can do. And every sort of few months we're seeing advancements there. But what we're actually starting to see now, and once again, more in the US, and this is very, very nascent, is how AI is starting to move from automation to actually autonomous capability to do things. And what I mean by that is you're starting to see some startups, very early stage, build agents that are, running auctions, for example. When you've got agents that are running auctions, they need wallets to be able to control who they pay, how they receive money, and really act almost like a human being. So I think this intersection of, agents and digital wallets and bringing all of that together is what we're going to see transpiring in the next couple of years on a much bigger scale, but still very, very early stages.
And with the, I guess, the businesses that you've invested in so far, are there any success stories that you can share?
Yeah, so I think there are a number of success stories, and I think you look at success in a couple of ways, right? So one is financial success, and I think if you look at our portfolio, we're an investor in Airwallex, for example, and I think everyone on this who's watching this will know that Airwallex is one of Australia's really, really, really great success stories. So amazing investment, amazing founder and team who've done great things. We also look at strategic success. And what that means is what has the company been able to do with ANZ to drive that new customer loyalty, new capability within the bank. And, if you look at some of what we've done, we can take a company like Cash Rewards. So we invested in Cash Rewards in 2020. We then privatized Cash Rewards in late 2021. Cash Rewards is now integrated into ANZ Plus, which is ANZ Bank's new digital capability. And we are we really we're starting to see some good integration between the two companies. Now with that, not only are we simply giving ANZ customers access to Cash Rewards, but we're actually helping with financial well-being of the ANZ customers. And there's a live early proposition that's already in place, but a lot more to come there. Yeah. So lots and lots of work that's happening there.
So that's really interesting example, actually, Justin, because if I think through, typically what tends to happen when there's an acquisition of that nature, the business gets absorbed into the bank, and then you lose all of the kind of benefits of having a nimble, small, agile business. How have you managed that transition? Where that Cash Rewards is now part of the bank, but still it's able to keep that agility.
So it's not part of the bank, and that's
not
magic,
right?
The same way that 1835I is not part of the bank, Legally, neither is cash rewards.
Right.
So what we did is we kept cash rewards as a separate company. Cash rewards is not part of ANZ. It's a separate company with its own identity, its own culture, its own processes, its own policies, like 1835I. What that means is we've been able to retain talent within cash rewards who, people that were there before, almost from the outset. But we also keep a separate board in cash rewards. So while there's a level of governance over the performance from an 1835I investment committee perspective, cash rewards has its own board. And the chair of the board, for example, is the person who used to be the CEO of Flybars, John Mirakovsky. So John comes in, he's run Flybars, he understands the loyalty space really well. He's an independent director who helps that company drive its strategy, make sure that they're staying true to their vision of a loyalty company, but also have a level of interface with the investment committee where there's good dual dialogue to make sure that the company in and of itself is on a good pathway, but there's also a good pathway to strategic partnership opportunities. So keeping that independence is really, really important. And that's something that we deeply believe in, because it comes back to culture. And we want to keep the culture of ANZ separate to the culture of these startups that we're working with.
The venture capital industry tends to get a lot of criticism. Some of it's warranted, a lot of it not so. Why do you think, particularly here in Australia, there seems to be this big expectation gap between founders and potential investors?
Look, I think, and I'm going to start off by saying that I think we are a very patient investor. As I said earlier on, we are very much there to drive strategic engagement with the bank, but we also very, very, very aware of our overall mission, which is to help founders get global dominance, right? Yeah. So we don't want to stifle the global dominance at the expense of just working with ANZ. We want to be a part of their journey, but not the whole journey. And
it seems for the last couple of years it's been global dominance, but get the profit with the first.
We'll get there.
Yeah.
And how we do that, and I'm very much talking about 1835I and the ANZ lens, is when we've got director seats on the boards of companies we invest in, we typically put directors on there who are independent. So yes, there are a couple of directors who might be ANZ employees and they bring a domain expertise to the board, but we've also got non-ANZ staff who sit on boards because they bring expertise or an understanding of the stage company that we're working with and the skills to help them grow. So I'll start off by saying that we think a lot about that, and we're patient from an investment perspective. And the benefit we've got, frankly, is we've got one LP.
Yeah.
And we've got one LP who we're very aligned with in terms of what we're trying to do. I think when you look at the broader industry, the challenge other investors have got that we don't have is they've often got multiple LPs, and they balancing, expectations there, whether it's, liquidity events that the LPs are looking for because they've been in the fund for a long time, or, seeing what's going on in other parts of the world. I think, they're dealing with a lot of stakeholders that they have to manage. And, we've had some very, very interesting economic times as well. We had a 2021 bubble, with, some companies raising money at incredibly, incredibly high valuations, and often based on projections that were probably very unrealistic and, maybe to some extent realistic for a very, very small period of time during COVID, but, in a world that wasn't overly real. And then, you move on a couple of years and companies are running out of money and they need to fundraise again, and you're facing into down rounds and all those sorts of complexities. And then, you've got a very tough job because you've got lots of different stakeholders that you need to think of, and your empathy.
I wanted to ask you about that, actually, if we could kind of dig a little deeper on that. You gave a really good explanation of the kind of history of 1835I and how you kind of brought these three separate components together in 2021. Literally, 12 months later, as you mentioned, the whole landscape has radically changed. What did you have to do, and how have you evolved kind of since that original kind of thesis around 1835I, and how have you evolved now, the kind of investment thesis?
Yeah.
And how does it differ to maybe what you kind of first had in mind?
Yeah. So that's a good question. So fundamentally, our thesis and how we, approach our business has broadly stayed the same. There are a couple of nuances that I'll talk about. First and foremost, what happened, as I said, we started in 2018. When we got to the end of 2021, we were 3 years old and we had deployed quite a bit of capital. So by the end of 2021, we had a portfolio of, around 13 companies plus companies that we were incubating in our lab. And what that meant is that we actually had a lot of work to do. Like, it's all fun to go and invest in new companies, but a lot of the really hard work is involved in managing the portfolio. And we've got a double job. One is managing the founders and managing the portfolio companies, and where we've got director representatives, they've got a big job to do in terms of working with those companies. But we also have to work with the bank. And we have to make sure that all those strategic theses that we invested on actually remain sound, and we're getting momentum both for the bank and for the founding team. So what happened at the end of, if we get to the end of 2021, we've got a pretty big portfolio. We've also got a shift going on in the broader market. So we're starting to see valuations going down, more pressure on companies. We start to see quite a big trend towards break even rather than growth at all costs. And I'll talk a little bit about that in more detail and how we think about that. But where that took us to is a world where we felt we had to do two things really, really well. The first thing we had to do is we had to make sure that we were there to support the portfolio companies that we had invested in. So we get to 2022 and, you start to see a lot of companies burning a lot of money. We can start to see down the path towards, next rounds of capital raising being required, all those sorts of things. And we said, hey, we need to make sure that we're doubling down and really, really supporting the companies, and especially the companies that are working strategically with us. The second thing we looked at is, now that we're at the end of COVID, how successful have we been in partnering with those companies? That's why we exist. We exist because we have to bring value back to the bank, and we have to bring value back to the companies through the banking relationships. And we realized that that's a really, really, really difficult thing to do. And while a number of companies had made some good progress in working with the bank, a number hadn't. So what we said at that point is, we're going to do two things. One is we're going to make sure that we're deploying appropriate resource in our team to work those partnerships, because that's our license to play. And the second thing we're going to do is we're going to learn where we've maybe not been so successful in driving partnerships. And the biggest learning we made at that point was, when we had done investments with a very loose thesis, we weren't getting good momentum on the partnership, versus when we had made investments on a really sound thesis. And a sound thesis is, here's the strategy, but also the business units really allocating money towards the business to drive integration. There are people in the business who are accountable for integration. People have got KPIs in the business that they're being measured on to drive into all those sorts of soft things. We need to make sure that we're really doubling down on getting that locked away. And what you start to see there's some companies that we'd invested in 4 years before, where we're probably going, we might not actually get to a point where there's, a strong thesis with all that support. So we need to work on that. But going forward, we need to make sure that that's absolutely front and center of how we invest.
Yeah.
So if you look at a recent investment that we made, which was an investment done late last year in Ceto Plus, we had done a very, very solid piece of strategy work with the business. So we said, hey, where's this commercial broker space going? What do we as an organization believe? And we believe that, digital technology, that's where we need to be playing in. We thought that the founders of Ceto Plus were really good. They've worked in banks, they understand the space they're working in, great founders, they already had a couple of really good people on their board, all that sort of stuff. And then we sat with the business unit and we said, okay, if this is the strategy that we're putting in place, do you have committed funding to drive the integration? Do you have accountability from a KPI perspective, so on and so forth? And we ticked all of that off. And we only got approval to do that investment from the investment committee once we had that joint commitment. It wasn't just putting capital in, it was also putting all the business resources in. So to summarize all of that, post 2021, we want deep conviction on that strategic partnership and conviction that the business is bought into it. And we also want to make sure that we are actively supporting the companies that we've invested in. And when we say actively supporting them, that's not just driving them to break even or profitability. That's very important. But we also try to stay true to what was the vision, how they're going to get global domination, and how we're going to support them with that, with the right amount of capital and the right amount of support.
Okay. Now, there's also a perception, I think, with VC that they're sitting in an ivory tower, going through their LinkedIn inbox, just replying to intermittently to people who pitch their business. Could you give us what the reality is of how you go out and actually find opportunities and potential partners for the bank?
Yeah, so we've got a few ways of doing it, right? So first of all, we've got a local dedicated investments team, and that team are comprised of people who have worked in the startup ecosystem and investment ecosystem for a number of years, often multiple years. So those people have just got a really, really good network of other investors in the space, but also they're well connected to founders, either because they've worked, even in the university system where they've invested, in commercializing startups there, or they've worked as operators in startups, so on and so forth. So there's a really, really good network that we formed there. We've got the bank, which is a great source of deal flow. I don't think anyone would appreciate how many founders go straight to Shane Elliott and say, hey, I've got a startup we think is interesting, and then Shane will put it into our team. So the bank's a really, really great source of investment. We've also got venture partners, one in the US and one in the UK, people that are very, very well connected. So for example, our venture partner in the US was one of the early Standard Chartered Ventures people in the US who has built an incredible network there, both with investors and founders. So we get great access to opportunities there. And then just being active in the ecosystem. So being active through Intersect, being active through Launchvic, attending events and just having networks there. So deal flow is no issue. There's loads of deal flow. I think coming back to your question, for us, and we have to be, super honest about this, we play in a very thin space.
Yeah.
We play in a space that is, as I said, it's on the fringes of fintech. It's not always just pure financial products. It's very much on the fringe, but that takes you into, much more constrained territory. And then within that, we have to go, well, we have to be looking for companies who can work with A and Z, because working with A and Z, you need to have a level of maturity. You have to have a team that is of an adequate size, because there'll be some things that, we need to do to drive partnerships. Adequate size doesn't mean 200 people or 100 people. It can be much smaller, but we need to have conviction that the team has got that muscle to be able to work with the bank. And then we need conviction on that strategic thesis. So there's generally a pretty thin territory that we work within, and we're honest with people. So, we get loads of inbound every day, and we're honest with people up front. Either it's, we don't think we can work with you for these reasons. We might love your vision. We might think it's great. And often we'll pass those people on to other investors who are in our network if we think relevant. And the ones that, the people that we meet that we think there is an opportunity, we upfront around our investment process. We're a lot quicker than we, would be with if we were in the bank, but there's still a process. We still have to have conviction on the strategic thesis. We have to have conviction on the company, and we have to build that conviction, but we have to get them across some of those key stakeholders in the bank as well.
I want to kind of talk about the state of fintech here in Australia and also globally. I guess first off, where would you kind of summarize Australia being in terms of a global fintech ecosystem right now?
Yeah, so it's a good question. I think, if you look at the world, there are really a small number of places where there's deep fintech ecosystems. So if we look at it, there's the east and west coast of the USA, which are big and vibrant and huge activity. There is there's a good sector in the UK and also in France, and a good emerging fintech ecosystem happening in France, and then there's a good ecosystem in parts of Asia as well. So we see some really, really interesting capabilities coming out of Singapore. We see some interesting capabilities coming out of Hong Kong. And then, of course, there's also some really, really interesting stuff that come out of India and China. And frankly, we just, haven't been able to get across those regions yet. And then Australia. So if we look at the world, that's sort of the, those are the territories that we look at. Australia punches above its weight, frankly, right? So if you look at, we get a lot of inbound, specifically the US, the UK, and Australia, and we often see really, really, really good businesses coming out of Australia in the fintech space. We saw in the state of fintech, the state of venture report last week that fintech is doing well again. Now, there's around $1 billion invested last year. It's not small. We've also seen some really, really great companies, grow overseas. Like I said, Airwallex, which is in our portfolio, but also some others. So I think we punch above our weight. I think we've got some really, really great talent in the country. I think, you're getting some very, very, very good banking talent coming out of the banks and starting to build their own fintechs. And in the state of venture report last week, we saw some really, really good funding rounds coming into some of those larger fintechs that are emerging here. So I think Australia is doing well and it's punching above its weight. I think, I'm going to put an obvious statement out here, but there's just a different risk appetite here compared to other countries. So when we go and specifically, meet founders in the US, and granted the pool of capital in the US is just so ginormous. So it's just, it's kind of easier to take a risk. It's absolutely phenomenal. So people there have just got a very, very different approach to risk taking. And you've also got some really, really great infrastructure like Y Combinator, for example, which starts to infuse, culture in that really young generation of founding businesses, being an entrepreneur from the day you leave university. I just don't think we've got there yet here, but I think the university system here is starting to get a lot better in terms of getting people to think about founding their own businesses. And just as an example, we often get involved in Monash and their program, and it's incredible to see how many 19 and 20-year-olds are starting to think about a startup being their first job rather than a corporate job. So we're getting there. We're just not at the, we're not where some of the overseas countries are yet.
Sam, the $50 million question could become $5 billion. You've just set up your own VC and you got a $50 million check to invest. Where would you invest it? And what's the one big, bold idea that you would back with $50 million?
So 50 million's a very, very significant number.
Yeah.
And I guess it depends if you are, if you're talking seed round or late stage check. So let's assume it's an earlier stage check.
It's earlier stage. It's something that's got you excited that you think this is truly going to change.
Now I think so. I'm going to put two hats on here. So as I said earlier on, we're seeing some incredible Horizon 3, ideas coming up. As I said, the intersection of AI agents and digital wallets and, sort of that convergence between AI and crypto. But I'm also going to say, we still invest for a bank, and that is still very, very, very bold and very new. So I'm going to go back to, as a strategic investor in a bank, where would I put that money? One of the big problems that banks face, but much broader than banks, and this is going to sound really boring to people, but one of the biggest challenges is managing non-financial risk. So if you think about the Royal Commission into Banking, all the issues around non-financial risk management. If you read the papers, you see, whether it's, there were frauds, there were scams, and this sort of failure to detect or manage those non-financial risk incidents early are constantly a point of contention. And what we're thinking and what we're seeing is, with the emergence of agents, we think there's a world when non-financial risk management can almost become automated. Right. So what that means is, and this is relevant for people that aren't even in banks. If you're on a not-for-profit board, one of the big things you have to do as a board member is say, is the risk management of this organization intact? And often directors sit there and they're like, how do we know? This is all sort of theory to us.
Yeah.
If you can build agents that go, yep, we know what your key risks in your organization are, whether you're a bank, whether you're a hospital, whether you're a not-for-profit, and we can understand what controls you've got in place to mitigate those risks, and we can test those controls to know that they're working. If you can build agents to do all of that, I think you've got a multi-billion-dollar business. And this has been sort of, concept that people have spoken about for a while. And I've seen some companies come up where, they go, we're good reg tech because we can ingest regulation and tell you where regulation changes, and you kind of get there, and no one can then say, well, what risk does that regulation actually mitigate, and what controls have you put in place to comply with the regulation and mitigate the risk? I think with agents, we're going to get to a point we can do that. So if anyone's building that sort of startup today, I put 50 million.
It's really interesting you should say that, Justin, because one of the biggest challenges that I've had recruitment-wise in this last 12 months is essentially head of compliance, chief risk officer roles.
Yeah.
And finding people who have that commercial acumen, but also can, have that first principles thinking about, right, this doesn't actually exist, or we're going into new territory. What are potentially some of the outcomes or probabilities of those outcomes, and how do we mitigate against them?
Yeah.
It's really difficult to find people who have that
the name
and personality set.
The name of this company is Virtual CRO. So
we've
spoken a lot about virtual CFOs, and we've seen, we've seen a lot of advancements around automated bookkeeping and accounting. I think virtual risk management with agents is the next big thing.
Yeah.
And I remember I was in Silicon Valley in 2019 and speaking to companies around this problem, because, once again, with my ANZ investor hat on, we talk about RegTech and what do we think opportunities are. And we're seeing companies that were doing some kind of interesting things with machine learning, specifically around the regulatory ingestion space. And you couldn't get past that into what are your risks, what are your controls, how do you test them? But we're getting there now. So my $50 million check would definitely go into that.
In terms of, I guess, how you kind of keep connected, just keep yourself abreast of what's going on. Obviously, you go and you meet a lot of people, but are there any podcasts that you listen to that kind of you found particularly useful?
I listen to a lot of different podcasts, but the truth is, I think in terms of keeping up, there's some great literature, that hits my inbox every day, and some really interesting tidbits. But the most valuable, to be honest, is, as I said, we've got a venture partner in the US, and he's incredibly connected to that ecosystem. And every 2 or 3 days, I'm getting a note from him. I've met this founder. I've met, I've been to that conference. I've seen this capability, and we're getting connected to the founders, making those relationships. And those half an hour sessions that I'm getting with those founders is really what that that's what brings the
Yeah.
insight back. And, frankly, when I'm speaking to my investment committee, it's coming from those meetings.
Yeah.
So the great podcast is great reading, but there's nothing like that human touch.
Yeah.
With people who are actually, firing ahead and building these things.
Well, we'll come to a wrap, Justin. We get some amazing talent listening to this podcast. If they're interested in careers at 1835i, where's the best place for them to go?
Justin at 1835i.com, and I will direct them to the right people. But we always happy to speak to great talent and, constantly changing our team, specifically given the lab and what we're trying to build.
And obviously we get, a lot of founders listening to this as well. If they've got a great idea or business that they're building, again, reach out to you.
Chat. Yeah.
Well, just
great way to source new opportunities.
Thank you so much for joining me today. Really great to get your insights. And before we wrap up, any big announcements for you guys this year, and what can we expect from 1835i in 2025?
So, look, right at the minute, we made a couple of announcements late last year, and there's a lot of work underway at the moment to bring those strategic propositions to life. There are 3 really, really interesting companies in our lab at the moment that we're hoping to put the next round of capital into, within the next few months. And we will definitely be launching those on socials as they progress. So
brilliant.
In the short term, there are 3 really interesting things happening there. Always wait and see with external investment opportunities that are coming our way.
Awesome. As always, folks, you can connect with me on LinkedIn. If you're new to the show, make sure to follow us wherever you listen to podcasts, or subscribe on YouTube. If you're coming back, thanks so much for your support. It really does mean a lot, and it really helps me in being able to get great guests like Justin onto the show. Until the next episode, keep well,